Hey everyone, welcome back to the channel. Today we are diving into an essential topic that all accountants, business owners, CEOs, CFOs, and investors must master: equity. You know those massive net worth numbers you see for companies like Apple, Amazon, Tesla? The secret to building that wealth is tucked away in the equity section of the balance sheet. From operations to issuing new shares of stock or buying back Treasury shares, every major corporate move impacts the owner's equity section. Retained earnings, paid-in capital, common stock. They sound like boring accounting terms, but mastering these owner's equity accounts is how businesses ultimately build empires. Let's explore and uncover the details of the equity section. First things first. What is equity? Equity, also called shareholders' equity or owner's equity, represents the residual value of a company's assets after deducting all liabilities. It shows how much the owners or shareholders really own. The accounting equation lays this out clearly. A company's assets must equal the sum of its liabilities and equity at all times. Equity is what's left over for the shareholders after paying off debts. Here's how you calculate it: total assets minus total liabilities. Net assets. This figure tells us what the company would have left if it sold all of its assets and paid off all of its debts today. It represents the net worth of the company in the eyes of its shareholders. It seems straightforward, doesn't it? You can calculate equity by subtracting liabilities from assets on a balance sheet at any point in time. However, there's much more complexity involved. The accounts within the equity section are influenced by accounting transactions governed by the double entry accounting system. To fully grasp equity, you must understand the specific accounts in the equity section and their relationship with all other elements of the balance sheet, assets and liabilities, and the income statement, revenue and expenses. In the last couple of weeks, I released 2 videos where I went over in detail the accounts that make up the assets and the liability sections of the balance sheet. Today, we will go over the most common accounts you will find under equity. The most common accounts under equity are common stock, additional paid-in capital, also known as APIC, preferred shares, retained earnings, dividends, or owner's distributions, and treasury shares. All these accounts are the components that make up the balance of equity. Let's take a look at each. Number 1, common stock and APIC. Common stock is the most fundamental type of equity and represents ownership in a corporation. Common stock represents the total amount received from investors in exchange for stock issuances. When a company issues common stock, it records the proceeds received. The common stock is typically recorded at its par value, and any amount received over the par value is recorded as additional paid-in capital. Par value is a nominal value assigned to each share. It is often set very low, such as a penny or even less per share. This is done to meet legal requirements. The par value of common stock has little to no relation to its market value, which is determined by supply and demand in the market. The primary purpose of par value for stocks is to establish a minimum price at which shares can be issued, ensuring that the shares are not sold below this value. For example, if a company issues 10,000 shares of common stock with a par value of $1 per share for $50 per share, the journal entry would be: you would debit your cash for $500,000, you credit your common stock for $10,000, and then you credit the difference, which is the additional paid-in capital, for $490,000. Another common component of equity is preferred shares. Preferred shares are also known as preferred stock, a type of equity that combines features of both common stock and bonds. They are called preferred because they have priority over common stock in several key areas, such as dividend payments and claims on assets in the event of liquidation. Now, there are many types of preferred shares with various features, but for this video, what is important is how they affect the equity accounts. Both preferred shares and common stock are recorded at their par value when issued. Any amount received above the par value is recorded in an additional paid-in capital account. Differences in recording of these two types of equity instruments are as follows. There's a difference in priority and classification. Preferred shares are listed before common stock in the stockholders' equity section due to their preference in dividends and liquidation claims. This reflects their higher priority over common stockholders. And the second difference is the dividend treatment. Preferred shares often have fixed dividends, which are recorded as a liability if they are cumulative and unpaid. For cumulative preferred shares, any unpaid dividends accumulate and must be paid before any dividends can be paid to common shareholders. Not all preferred shares are cumulative. Some are non-cumulative. For example, if a company declares a $2 per share dividend on 10,000 outstanding preferred shares, the journal entry would be: you debit your retained earnings for 20,000 and you credit your dividends payable for 20,000. Fourth component of equity we are going to discuss in this video is retained earnings. Retained earnings are the accumulated net income that a company has reinvested in its operations instead of paying them out as dividends. The retained earnings account tracks the cumulative profits and losses retained in the business over its life, minus any dividends paid out to shareholders. It's a measure of the company's ability to reinvest its earnings or pay dividends to shareholders. Retained earnings are recorded in the stockholders' equity section of the balance sheet. The process involves the following steps. You start with the retained earnings balance from the previous period. You add the net income or subtract the net loss for the current period. And then you subtract any dividends paid out or distributions to shareholders or owners. The resulting figure is the ending retained earnings balance, which is reported on the balance sheet under the shareholders' equity. Another component of equity is dividends or owners' withdrawals. These are payments made by a company to its shareholders or owners as a distribution of profits. As I mentioned when we discussed the formula for retained earnings, dividends reduce the accumulated profits available. When dividends are declared and paid, the balance sheet would show a decrease in cash and a decrease in retained earnings. For example, suppose a company declares and pays a cash dividend of $1 per share on 100,000 outstanding shares. The journal entries would be: you debit your retained earnings for $100,000 and you credit your cash for $100,000. And lastly, let's discuss treasury stock. Treasury shares, also known as treasury stock, refer to previously issued shares that a company has repurchased from shareholders. These shares are held by the company and are not considered outstanding in the market. Treasury shares do not receive dividends, have no voting rights, and are not included in the calculation of earnings per share. The cost of the repurchased shares reduces the value of the company's equity as these shares are no longer outstanding. For example, if a company repurchases 1,000 shares at $10 per share, the journal entry would be: you debit treasury stock for $10,000 and you credit your cash for $10,000. And that's all for today's video. I hope you now have a solid understanding of the different types of equity accounts and their significance in business finance. If you found this breakdown helpful, make sure to click that subscribe button and hit the notification bell so you can be notified when I release more videos. Your support helps me continue to create valuable content. Remember, equity is more than just a number on a balance sheet. It's a reflection of a company's past, present, and future. By grasping the nuances of each equity account, you unlock the power to analyze a company's financial position, evaluate its growth potential, and ultimately make strategic choices that maximize shareholder value. Keep learning, keep growing, and keep building that equity knowledge. It's the key to unlocking a world of business opportunities. Thank you for watching. See you next time.